Ever bought a stock only to realize you overpaid? Or watch a bargain keep dropping? Well, today I'm going to show you the exact tool I use to avoid both of those mistakes. We're diving deep into InvestingPro's fair value model, the proprietary engine that powers our stock analysis and helps investors separate signal from noise. You'll learn how this model works under the hood, why it's different from traditional analyst price targets, and how you can use it to make smarter, more confident investment decisions. Now let's get started. So let's kick off with the basics. Fair value is InvestingPro's estimate of what a stock is intrinsically worth based on its fundamentals. Think of it this way. The market price is what investors are willing to pay right now, influenced by sentiment, momentum, and short-term narratives. Fair value, on the other hand, is what the company is actually worth based on its cash flows, earnings power, balance sheet strength, and growth prospects. The gap between these two numbers, market price and fair value, is where opportunity lives. When a stock trades significantly below its fair value, it may be undervalued, a potential buying opportunity. When it trades well above fair value, it may be overpriced. But here's what makes InvestingPro's fair value different. It's not based on gut feeling, market sentiment, or a single valuation ratio. It's a comprehensive, multi-model system built in-house by our quantitative team. Unlike Wall Street consensus targets, which simply average what different analysts think, fair value uses a rigorous, formula-based approach that weights up to 17 independent valuation models to arrive at a single risk-adjusted price target. That means it's grounded in objective financial data, not subjective forecasts or behavioral biases. For investors who want to cut through the noise and focus on what really matters, the numbers, that's a significant edge. Now let's take a look at fair value under the hood. How does fair value actually work? Well, InvestingPro's model uses up to 17 independent valuation models to estimate a stock's intrinsic worth. Each model approaches valuation from a different angle, and together, they provide a comprehensive picture. Let me walk you through the main categories. First, we have cash flow-based models, like discounted cash flow or DCF. These models estimate what a company's future cash flows are worth in today's dollars. They're especially useful for mature companies with predictable cash generation. Second, earnings-based models, including earnings power value and PE-based approaches. These focus on the company's ability to generate profits and compare that to similar businesses. Third, asset-based models, like price to book and tangible book value. These look at what the company owns, its assets minus liabilities, and ask whether the market price reflects that underlying value. And fourth, relative valuation models, which compare the stock to its industry peers using multiples like EV to EBITDA, price to sales, and PEG ratios. Each of these 17 models generates its own fair value estimate, but here's where it gets interesting. Not all models are created equal, and not all models work equally well for every stock. That's why the system applies dynamic weighting. Models with stronger historical accuracy for a given sector or company profile receive higher weight. Conversely, models that are less reliable in certain contexts are weighted lower. For example, a DCF model might be heavily weighted for a stable utility company with predictable cash flows, but less weighted for a high-growth tech startup with volatile earnings. The system also adjusts for risk. Stocks with high volatility, inconsistent profitability, or weak balance sheets get more conservative fair value estimates. This helps filter out false positives. Once all models are weighted and risk adjusted, they're aggregated into a single fair value estimate, the number you see on every InvestingPro stock page. And here's what makes this approach powerful. You're not relying on one person's opinion or one model's assumption. You're getting a consensus of quantitative methods, each stress-tested and calibrated for real-world performance. Plus, the model is fully transparent. You can click into any stock's fair value breakdown and see exactly which models were used, what weights they received, and how they contributed to the final estimate. That level of transparency is rare in the investment world, and it gives you full control over how to interpret and apply the data. Now, you might be wondering, how does fair value compare to the analyst price targets you see on Bloomberg or Yahoo Finance? Great question. And the answer matters because the differences can be significant. Wall Street consensus price targets are created by averaging the forecasts of sell-side analysts at major banks and research firms. These analysts issue buy, sell, or hold ratings along with their 12-month price targets. The problem? Those targets are often influenced by factors outside of pure valuation. Analysts might anchor to recent price momentum, they might be swayed by management or guidance or near-term catalysts. And even in some cases, they may face conflicts of interest, especially when their firms have banking relationships with the companies they cover. Fair value, on the other hand, is formula-based. It doesn't care about sentiment, momentum, or narratives. It just looks at the fundamentals: cash flow, earnings, growth, and risk. And it applies this consistent, transparent logic across thousands of stocks. That's why you'll often see fair value diverge from consensus, sometimes even meaningfully. Take a recent example, Apple. Wall Street consensus might reflect bullish sentiment around new product launches or services growth. Fair value, meanwhile, might be more conservative, factoring high valuation multiples and slowing revenue growth. So, how do you actually use fair value to make better investment decisions? Let's walk through a practical framework. Step 1. Identify valuation gaps. Start by looking at fair value upside or downside. This tells you how far the stock would need to move to reach its estimate intrinsic value. A stock trading 30% below fair value with strong fundamentals? That's a signal worth investigating. A stock trading 40% above fair value with weak cash flows? That's a red flag. Step 2. Validate your quality metrics. Fair value tells you if a stock is cheap or expensive, but cheap doesn't exactly mean good. Check the stock's financial health, profitability, and growth scores. A high fair value upside paired with strong ratings is a much more compelling case than valuation alone. Step 3. Understand the model breakdown. Click into the fair value details and review which models are driving the estimate. Are most models aligned? If 15 out of 17 models agree the stock is undervalued, that's strong conviction. If models are split, it may signal uncertainty or structural changes in a business. Fair value works best as part of a holistic process. Use it alongside InvestingPro tips, earnings forecasts, and peer comparisons to build a complete investment thesis. Fair value isn't a crystal ball. It won't tell you what a stock will do tomorrow or next week, but it gives you a rational baseline, a North Star to guide your decisions when markets get emotional. And over time, stocks tend to revert to their fair value. By buying undervalued quality and avoiding overpriced risk, you're stacking the odds in your favor. Head to Investing.com and explore Investing Pro. QR code is on the screen right now. See you in the next video.